Hi guys, it's Stock Curry, and everybody's talking about the CPI inflation report that's coming out on Tuesday, but I'm going to show you why it might not matter. I've also got some other news that actually could move the markets, so let's get into it. The Consumer Price Index, or CPI, inflation report is coming out on Tuesday morning, and it has the potential to deliver some bad news. Economists are expecting that CPI is going to show a 0.4% month-over-month increase in January, although it will show a 6.2% year-over-year increase, which is a decrease over last month's 6.5% CPI number. It should be noted, however, that the Cleveland Fed's Nowcast tracker of CPI components is pointing toward inflation growth of 0.65% month over month and a 6.5% year over year. That is significantly higher than what the market is pricing in. Getting into the specifics, the CPI, or Consumer Price Index, is being released at 8:30 a.m. Eastern Time, or about 1 hour before the market opens on Tuesday. The Consumer Price Index is expected to have gone up by 0.4%. This is significantly higher than the negative 0.1% that we got last month. And core CPI is expected to have gone up by 0.3% month over month, which is the same as last month. Now, even though the month over month increase is going up, the year over year is actually going down, and that's because we are comping against much higher inflation from last year. The year over year CPI is expected to come out at 6.2%, which is much lower than last month's 6.5% year over year reading. And core CPI is expected to come in at 5.4%, again, lower than last month's 5.7% year over year reading. Now, as I said in the introduction, even though the CPI inflation numbers are coming out on Tuesday, and they probably will move the markets at least on Tuesday, in the long run, they really don't matter. And that's because when we look at the inflation data that's been coming out lately, at least over the past 4 months or so, the market has been pretty much ignoring any and all fundamental data that comes out in this economy. The market has been ignoring inflation data. They're ignoring the Fed and what they say. They're ignoring bad earnings. The market is just ignoring everything, and it's just rising. The fact that we had a more than 1% rise in the markets the day before this inflation data comes out is really unprecedented compared to what we saw last year. And it just is a great indicator that the market just does not care about the CPI inflation data. The market just wants to rise. It just wants to go up. So if this CPI inflation data comes out on Tuesday and it shows that, yes, we did get a month over month increase, there's a very good chance that the market is going to ignore that. And instead, the market is going to focus on the year over year decrease. And the market's going to say, hey, look, inflation's continuing to go down. We're getting closer to the Fed's 2% target range. Let's go ahead and buy stocks. So I say there's a greater chance of a rally on Tuesday than there is of a market sell-off. Not because the inflation data is good. Don't get me wrong. A 0.4% month-over-month increase is really bad. It shows that inflation is coming back. It's starting to rise again. The Fed's raising of interest rates has not done enough. And it's really, really bad news. But with the year-over-year number going down, I think the market's probably going to focus on that instead, because the market tends to ignore the bad news and focus only on the good news. So the market's probably going to focus on that year-over-year number coming down and say that's a good thing, and therefore it's going to rally. Now, that's just a guess. Nobody knows what the market is going to do, and nobody could possibly know. Even if you knew what the CPI number was ahead of time, you still would have no clue what the market was going to do. I have seen CPI reports that were dismal that caused the market to rally 5% in a single day. You literally just have no clue. And no matter what the market does pre-market in that first hour from 8:30 to 9:30, it doesn't matter. We have seen the market rise pre-market and then sell off during the day, and we've seen the market fall pre-market and then rally during the day. So the pre-market is not an indicator of what's going to happen during the day. I want to make that very clear. If just because the pre-market goes down does not mean the market's going to go down throughout the day, and just because the pre-market goes up does not mean the market's going to go up throughout the day. Anything could happen. This market has been extremely difficult to predict because it is rising on FOMO and it's rising on this extremely bullish market sentiment and this extreme greed level that we're in on the fear and greed index. It's not rising based upon technicals or fundamentals, and therefore it's very, very difficult to predict how people are going to feel and what people are going to trade based upon their feelings. So I just want to give that warning that the actual number, the actual print probably isn't going to matter that much. Ultimately, the market's going to trade based upon how they feel. And it's more than likely going to go up just because the market overall has been rising. Now, aside from the CPI print that's coming out Tuesday morning, there's a new inflation warning for consumers that's coming from the supply chain. Warehouse and distribution centers are pushing the rates higher, with U.S. storage prices up 1.4% month over month and up nearly 11% year over year. Logistics managers are warning of a persistent source of inflation in the supply chain, and they're saying consumers should be ready for the effect it will have on their wallets. The Fed is now more focused on services inflation as it expects the pressure in goods inflation to continue a downward trend. But the logistics issues suggest that there will be some elements of sticky inflation on the goods side of the equation. Some shippers are holding their products in containers on chassis because of full warehouses and full distribution centers. But this means that they're incurring charges which are then passed on to the consumer. These charges could be tens of millions of dollars per quarter, and Brashear warns that these charges, on top of weaker consumer demand, will ripple through earnings. Even with the rate of inflation slowing, higher consumer prices are expected to remain in effect. So this overflowing inventory problem, the same problem that sent stocks like Target and Walmart crashing last year, has come back. And this could spell disaster for future earnings. And it could also mean that the price of goods starts to go back up again, which could push inflation back up again as well. Now, the question for the Federal Reserve is, are they going to raise rates too much and cause a major recession? And the real question is, are we going to get a hard landing or a soft landing? That is a major recession or a mild recession that nobody really experiences. And some economists say neither, if growth continues to accelerate. Surprising strength in hiring and consumer spending last month, together with signs that the demand for autos and housing might be stabilizing, now have some economists pointing to a third scenario that seemed improbable just a few weeks ago: an economic growth upturn. A no landing scenario is a present-day reality. Economists surveyed about the probability of the U.S. in a recession over the next 12 months dipped in the last month after a strong jobs report. So the strong jobs report has caused some economists to think that we might not get a recession, but to be sure, many economists still expect a recession this year. Another possibility is a rolling recession. Rolling recessions has become a popular term these days for what the U.S. has faced since the slowdown that started early last year. Housing, manufacturing, and finance have all shown signs of contraction, although the overall economy has broadly escaped the recession definition. Some economists think that we will get a rolling recession, that is, where certain sectors of the economy are in recession, but the overall economy avoids an actual recession. So some sectors might seem like they are in recession, maybe the housing market over a few months, and then later maybe technology stocks for a few months, and then later maybe another sector for a few months. But they happen sporadically and they don't happen all at the same time. And this, even though some sectors are going to be in recession from time to time, could cause the overall economy to avoid an actual recession. This is something we'll have to keep our eyes on. It will make stock picking quite difficult as some sectors perform very poorly while others go on massive rallies. Still, despite the strong jobs report we got in January, companies continue to lay off employees. Twilio says they're going to lay off another 17% of their workforce. This announcement comes after they already laid off 11% of their workforce back in September. And with interest rates in the bond market rising, investors are exiting U.S. stocks during this 2023 rally. Money is rapidly flowing out of U.S. equities, that is stocks, and money is going into bonds. The thought here is, why would you invest your money into a stock market that is very, very risky when you could put your money into bonds and have a nearly guaranteed 5% interest rate? This is something that was unheard of prior to this year. Prior to this year, at least since 2009 onward, interest rates have been near zero, which means anybody who bought bonds would have been getting about a 1% interest rate. That doesn't even keep up with inflation at a normalized 2% rate. So investing in bonds was not a good alternative to the stock market over the past 10 years. And that's why all of this money was dumped into stocks. It's ultimately how we ended up with these massive PE ratios and these massive PS ratios that we've seen over the past decade. However, now that interest rates are getting back to normal and they're getting back up to that 3, 4, 5% range that they've historically been at, bonds are now attractive once again. And especially older investors, as well as a lot of investors who have very large assets, such as pension funds, they would rather have their money in bonds earning a 4 or 5% interest rate that is safe and secure, rather than having their money in the stock market that might generate an 8% return, or it might drop 30 or 40% like it did last year. Certainly, the idea of having a safe 5% annual return is a lot more attractive than a very risky 8% annual return in the stock market. And that is why we are seeing a lot of money flowing out of stocks and into bonds. Ultimately, this is going to have the effect of lowering stock prices as it lowers multiples and gets stocks back down to around fair value. Currently, price to sales ratios are higher than they were during 2008 and higher than they were at the peak in 2021, pointing to the stock market currently being more overbought than it has been at any point in recent history, and fundamentally due for another significant downturn. Although, as I've shown you in the technicals many times, currently the market sentiment remains bullish, and it will probably be many months down the road before we actually get a sell-off. Now, even though company earnings have been dismal with an overall 4.6% decline in quarterly earnings, the first decline we've seen since the COVID pandemic, some stocks are rising. Shares of Palantir popped as it reported its first profitable quarter ever. Palantir reported an earnings per share of 4 cents versus 3 cents expected. Revenue also beat. It came in at $509 million versus $502 million expected. The company also reported its first ever quarter of positive net income on a GAAP basis at $31 million. The CEO, Alex Karp, said, with this result, Palantir is profitable. This is a significant moment for us and our supporters. And yes, I did buy Palantir stock after the close today. Now that Palantir is profitable, I am comfortable buying the stock. I have been avoiding unprofitable companies during the bear market because unprofitable companies get absolutely destroyed in bear markets. But profitable companies, now those can rise. So I did buy 100 shares of Palantir today after the close. We'll see how the stock trades over the next few days and weeks. I might be adding on to that position if I can get some good entry points. But I was happy to buy 100 shares after the close. Very happy to buy a profitable company now that Palantir is actually reporting a profit for the first time ever in the company's history. By the way, if you want to know everything that I buy and sell and how we make money in the market, no matter whether it goes up, down, or even trades sideways, you can come learn options with me in my We Profit Day and Night coaching program. Now through the end of February 14th, I'm running a Valentine's Day special because I love you guys so much and I appreciate your support. I am offering a discount on the entire coaching program. If you want to take advantage of that, make sure you schedule a call with my onboarding specialist on February 14th. You cannot schedule a call any later than that. The sale ends on February 14th. So get that call scheduled on February 14th. Speak with my onboarding specialist, and he can give you all the current rates and the sales and promotions and everything. You can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. Now, I know if you've been a longtime supporter of this channel, you probably really enjoy the market update videos I put out on Sundays. You might have noticed that I missed yesterday's market update video, but I wanted to let you know that I am putting the entire market update in a free newsletter that gets emailed out to everybody. So if you want to sign up for that free email newsletter, we got over 2,000 people who have signed up for that newsletter already. You can sign up for that at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. And you'll get the entire pre-market preparation in your email inbox every Monday morning or Sunday night, depending upon where you live. If you enjoyed this video and got a lot out of it, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed the video that I put up Thursday talking about the CPI as well, make sure you go watch the last video that I uploaded here.